Welcome to Tech Money Madness, your daily U.S. stock market podcast. It is June 2026.
Glad to be here.
So today we are looking at a market that honestly feels like it's operating in two completely parallel universes.
Oh, absolutely. It is quite the split screen right now.
Right. Like on one side of town, you've got this tech founder preparing to take a space exploration company public at a staggering $1.7 trillion valuation.
Just massive numbers.
Yeah, and then on the other side of town, everyday consumers are, well, they're so financially stretched that a $79 billion Wall Street fund is literally locking its doors.
Yeah, they're having to prevent a stampede of investors from just, pulling all their cash out.
Exactly. So we have a lot of source material to get through today, pulling specifically from the daily market briefing. And our mission for this deep dive is really to unpack these profound contradictions.
Yeah, to understand where the market is heading for the second half of the year, you really have to look at the friction here.
The friction between the tech sector and everyone else.
Exactly. It's the explosive, capital-heavy realm of artificial intelligence colliding with the physical economy of the everyday consumer. And we really need to understand how these two economies are violently crashing into each other.
But before we get into all the corporate trauma and the individual stock movers, let's establish the macroeconomic baseline for the day.
Always a good idea.
So if you were watching the indices, the biggest global mover dictating the early tape was oil. We actually saw crude prices decline by a full 3% today.
That is a significant drop.
Right, and the daily market briefing ties this drop directly to geopolitical reports indicating that President Trump is reluctant to restart the Iran war.
Yeah, and to look at the market mechanics of that purely objectively, without any political lens at all, it really just comes down to how commodities price in uncertainty.
Like a risk premium.
Spot on. Whenever there's the potential for armed conflict in a major oil-producing region, the market automatically bakes this geopolitical risk premium into the price of a barrel of oil.
Because traders are just assuming supply chains might be disrupted, right?
Exactly. So the price shoots up. But when reports surface indicating a reluctance to actually engage in that conflict, well, that assumed risk just evaporates.
So the premium deflates.
Exactly. And that deflation is the 3% drop you saw today.
And, I mean, a drop like that isn't just an isolated event for energy companies, right? It ripples out.
Oh, for sure. Cheaper oil lowers fuel costs for transportation, for logistics companies. It alters inflation expectations at the federal level.
Which is huge.
Right. And in theory, it should also act like a mini tax cut for the everyday consumer, giving you a few extra dollars at the gas pump. It basically shifts the entire foundation of the trading day.
Yeah, but here is the catch. Even with that theoretical relief at the pump, the domestic economic undercurrents driving today's volatility, they tell a much darker story about the consumer.
They really do.
Because the new economic data we received today shows a significant surge in long-term unemployment.
Yeah. And the headline unemployment numbers, they often mask the reality of what is actually happening on the ground.
Right. It looks fine on the surface.
But long-term unemployment is not just a temporary blip on a spreadsheet. We are talking about profound, deeply entrenched, hidden costs for workers and the broader economy.
What kind of hidden costs?
Well, the data shows ramifications that are obviously financial, but they're also emotional. They impact family health and stability.
Wow, yeah.
And the crucial takeaway for you, if you're managing a portfolio right now, is that these impacts linger long after a worker eventually re-enters the workforce.
I was reading through those neighbor notes, and it honestly reminds me of, like, a financial long COVID.
Oh, that is an incredibly apt way to frame it.
Think about it. You don't just get a new job on a Monday and suddenly, poof, the last 8 months of mounting credit card debt and depleted savings just magically vanish.
Right. The debt is still there.
Exactly. The acute phase of being unemployed might technically be over when you sign that offer letter, but the lingering symptoms remain. You have a decimated emergency fund. You have delayed medical care that now needs to be paid for. And critically, you develop these hyper-conservative spending habits.
Yeah, the psychology of it is fascinating. When you experience that level of financial trauma, you just go into full preservation mode.
Right. So the employment numbers technically recover, and the government says, hey, the economy is healing, but your actual behavior as a consumer doesn't recover for years.
And if we connect this to the broader market, for you, the listener, trying to figure out why retail stocks are behaving so erratically right now, this underlying labor weakness acts as, well, an invisible anchor on the economic recovery.
Because they just aren't spending.
Exactly. When a huge portion of the workforce is suffering from this financial long COVID, they aren't upgrading their smartphones. They aren't booking vacations. They are entirely focused on rebuilding their safety nets.
And that preservation mode bleeds directly into corporate earnings.
Unavoidably.
Which is exactly why we are seeing panic starting to bubble up at both the institutional level and, the mall. Let's look at the institutional side first, specifically Blackstone.
Oh, right. The gating.
Yeah. The briefing notes they just announced, they are restricting withdrawals from their BCRD fund. This is a massive $79 billion private credit fund.
Massive.
And redemption requests have risen so high that Blackstone had to step in and put up the gates.
Yeah, this is a textbook liquidity crunch
Right.
signal. And we should probably explain the mechanics of why this happens.
Yeah, break that down for us.
So BCRD stands for the Blackstone Private Credit Fund. And private credit is not like buying, a publicly traded stock or a government bond.
Right.
This involves direct lending to private, often mid-sized companies. So these are highly illiquid loans.
Meaning you can't just log on to a brokerage app and sell a $50 million private loan with the click of a button.
Spot on. There's no active secondary market to quickly offload those assets.
Yeah.
So when investors get spooked by the macro environment and they start asking for their cash back en masse.
The fund can't pay them.
Exactly. The fund cannot just liquidate private loans overnight without taking devastating losses. So to protect the fund from essentially collapsing under a bank run, Blackstone capped withdrawals at 10% of the fund's net asset value, or NAV.
Let's define NAV quickly for anyone who might be unfamiliar.
Sure. Net asset value is simply the total value of all the assets the fund holds, minus its liabilities.
Okay.
By capping withdrawals at 10% of that total value, Blackstone is telling investors, look, 90% of your capital is effectively trapped for the time being.
Which is terrifying for an investor.
It adds serious fuel to the growing concerns about liquidity in private markets. Institutions are locking the doors because the underlying assets simply cannot be converted to cash fast enough to satisfy the panic.
And you take that high-level, billions of dollars institutional anxiety, and you pair it with what is happening in everyday retail. Which brings us to Lululemon.
Today's top loser.
Yep, they closed down 5%, and they completely slashed their annual outlook.
Yeah, and the reasoning Lululemon's management provided was unusually blunt. I mean, they cited negative media commentary, but more importantly, they admitted to highly disappointing product launches.
Just bad products.
Right. And perhaps the most concerning part for shareholders was the company's own forward guidance, where they explicitly stated they expect the situation to worsen before it improves.
Ouch.
Yeah, it is really rare to hear that level of pessimism directly from an executive team, and it obviously resulted in extremely weak guidance for the full year.
Okay, but I have to push back on the narrative here just a little bit.
Go for it.
Are we genuinely seeing a systemic macroeconomic failure connecting these dots? Like, does the straight line really go from long-term unemployment to Blackstone gating a private credit fund all the way down to Lululemon dropping 5%?
That's the big question.
Right. Or is Lululemon's hit today just a localized failure? I mean, maybe they just designed some really ugly athleisure wear this season, and it has absolutely nothing to do with Blackstone or the broader economy.
That is the pivotal question you need to ask yourself today as an investor. And the reality is, it's a synthesis of both.
How so?
Well, did Lululemon have internal execution errors with their apparel designs? Yes, they openly admitted to unforced errors. But you cannot isolate those missteps from the broader macro environment. Let's go back to your financial long COVID analogy. In a booming, flush economy, a premium brand like Lululemon might easily survive an ugly product line.
Because people just buy anyway.
Right. Consumers have excess disposable income, so they ignore the ugly seasonal items and just buy the classic staple leggings instead.
The brand loyalty kind of carries them through the mistake.
Exactly. But when consumer liquidity is tightening up, when people are operating in that preservation mode we talked about, consumer forgiveness completely evaporates.
Ah, that makes sense.
You no longer get the benefit of the doubt. A bad product launch in a tight economy doesn't just result in a slight miss on quarterly earnings, right? It results in a 5% drop in market cap in a single trading session. The margin for error is effectively zero.
It's a totally unforgiving environment. You basically have to be flawless.
Yes.
Unless, of course, you're operating in the second economy we mentioned at the top of the show, the trillion-dollar tech contrasts.
It's a totally different world.
It really is. Because while everyday labor and retail are severely tightening their belts, the tech, AI, and space sectors seem to be existing in a completely different financial reality. We have to talk about the SpaceX IPO news from the briefing.
The numbers are just staggering.
Yeah.
SpaceX is reportedly targeting a $135 IPO price. And if they executed that price, it could give the company a valuation of $1.77 trillion.
Which is insane.
It immediately makes them the seventh biggest company in the United States, public or private.
So what does a valuation like that mean for Elon Musk personally?
Well, it means his personal net worth is poised to sail comfortably past the $1 trillion mark. His equity in SpaceX alone would be worth over $866 billion at that valuation.
Wow.
And, a public offering of this sheer magnitude creates massive, immediate ripples across the rest of the market.
Yeah, and we saw that ripple effect today with EchoStar. They experienced a huge surge in options volume today. And the catalyst is purely because they hold an estimated 3% stake in SpaceX.
Yeah.
But I think it's worth explaining the mechanics of a trade like that. Why are traders swarming EchoStar instead of just waiting for the IPO?
It comes down to proxy trading.
Hmm.
SpaceX is currently private. Retail traders and even many institutional funds, well, they can't buy shares directly yet.
Right.
But the market hates waiting when there is this much hype. So traders look for a proxy, a publicly traded entity, that acts as a backdoor into the private asset.
Because EchoStar owns that 3% slice.
Exactly. Buying EchoStar options becomes a way to gain synthetic exposure to the SpaceX valuation before the actual IPO happens. It's like a gravitational pull. Anything orbiting a $1.77 trillion behemoth just gets dragged upward.
It feels like absolute IPO euphoria.
It is.
But reading further into the daily market briefing, it's pretty clear this euphoria is not just a blank check for anything with a tech label. Like we saw the quantum computing company Quantinuum today.
Oh, yeah.
They had their much-anticipated NASDAQ debut. They even upsized their offering because they thought demand was so hot, and the stock just closed completely flat.
Yeah, a flat debut after an upsized offering in a supposedly red-hot sector is a glaring warning sign.
And even the established giants, the ones actually succeeding in the AI space, they're dealing with intense physical world friction. Amazon closed down 2% today, and the internal dynamics driving this drop are incredible. You have Amazon's own senior engineers publicly criticizing the company.
Yeah, that was a surprising story.
Right. They are angry because Amazon is pouring billions of dollars into building out enormous AI data centers while simultaneously laying off 30,000 staff members.
It perfectly encapsulates the tension defining the current market. You have this astronomical capital expenditure going into infrastructure for the future, servers, cooling systems, graphics processing units.
But that capital has to come from somewhere.
Right. And right now, it is being extracted directly from the human workforce. The engineers are essentially blowing the whistle on the internal contradictions of gutting your institutional knowledge just to buy more hardware.
It honestly feels like the executive team is building a multi-billion-dollar luxury penthouse on the roof of a skyscraper while simultaneously firing the entire building's maintenance staff in the basement.
That's a great visual.
Like, sure, the penthouse is going to look amazing for the investors, but who is going to fix the plumbing when the pipes inevitably burst? Is this internal friction, like the destruction of morale and institutional knowledge, is that going to ultimately stall big tech's momentum?
Historically speaking, technical debt and organizational debt always come due. You can automate processes and invest heavily in server infrastructure, but if you hollow out the engineering teams, the maintenance staff from your analogy, you risk severe operational failures down the line.
Because servers still need humans.
Exactly. They still need human oversight to integrate with legacy software. Wall Street, however, tends to reward ruthlessness and efficiency in the short term. The 2% drop in Amazon today suggests that the market might be showing some hesitation, perhaps worrying that management is cutting a little too close to the bone. But make no mistake, the overarching AI mandate remains the dominant force pushing the indices.
And that brings us perfectly to our look at the day's specific high-volume market movers. Because despite the internal friction at Amazon or the flat debut of Quantinuum, the AI boom remains the absolute center of market gravity.
Without a doubt. If we pull up the heaviest trading volumes today, NVIDIA is once again dominating the tape.
No surprise there.
Right. Their AI data center business is thriving, driven by just relentless growth in their optimized chip designs across multiple sectors. And their momentum was highlighted today by their keynote presentation at the Bank of America 2026 Global Technology Conference.
And Apple is right alongside them in terms of volume today, too.
Yes, Apple is seeing enormous trading volume, and that is almost entirely driven by forward-looking anticipation. Their Worldwide Developers Conference, WWDC, is coming up soon, and the market is practically holding its breath for major AI integration announcements regarding the iPhone ecosystem.
And Tesla remains highly active today, which is standard given their valuation and the retail trading interest they always attract.
Right.
But amidst all these trillion-dollar tech titans, I want to highlight a truly bizarre outlier from the briefing.
Oh, this was wild.
One of today's top gainers was Zoetis. They were up 2.5%. And the catalyst, a confirmed screwworm case in Texas.
It is a stark, almost humorous reminder that while artificial intelligence is eating the digital world, biological realities still move markets in the physical world.
Yeah, screwworms.
Right. Zoetis is one of the largest animal health and pharmaceutical companies on the planet. Any outbreak of disease, parasites, or agricultural threats in livestock immediately drives their stock up. Traders are just anticipating a sudden spike in pharmaceutical sales to combat the outbreak.
Biology undefeated by silicon, at least for today.
Very true.
But bringing it back to the tech giants for a second, I have a pointed question for you based on the tape we just walked through.
Right.
If Apple and NVIDIA are soaking up all the trading volume and all the oxygen in the room with this AI hype, does Quantinuum's completely flat debut suggest that investors are fatigued? Like, are they just tired of taking risks on anything that isn't already an established mega-cap tech giant?
You know, this touches on a critical issue of market breadth. I do believe we are seeing a form of fatigue, but it is more accurately described as a flight to perceived safety within the growth sector itself.
Safety and growth.
Right. Investors absolutely demand exposure to the AI revolution, but they want it through companies that possess infinite balance sheets. They want the safety of Apple's cash reserves or NVIDIA's market monopoly. A new entrant like Quantinuum, even operating in a futuristic sector like quantum computing, it just doesn't offer that downside protection. The market is effectively saying, you know, we believe in the technology, but we only trust the established titans to actually execute it without going bankrupt.
That makes a lot of sense. So as we wrap up today's deep dive into the daily market briefing, let's pull all these threads together.
Let's summarize the 5 key themes driving the tape. First, we start exactly where we just left off, the AI boom.
Right.
It is the undeniable engine of market growth right now with NVIDIA and Apple at the helm. Second, we have deep economic uncertainty.
The hidden costs we talked about.
Exactly. The lingering trauma of long-term unemployment and the liquidity gates going up at Blackstone, they're acting as a heavy anchor on the broader economy. Third is IPOs and funding. Despite the fatigue with smaller entrants, the sheer gravity of a potential $1.77 trillion SpaceX valuation shows that massive capital is still eager to move for the right target.
Yep.
Fourth, sector trends. Technology remains the absolute kingmaker of the major indices. And finally, market volatility. From a 3% drop in oil shifting the macro baseline to a 5% drop in Lululemon due to tightening consumer wallets.
That's a screwworm outbreak.
Right, a screwworm outbreak bumping Zoetis. The market is incredibly reactive to both digital and physical realities right now.
It is a tremendous amount of conflicting data to process. But I want to leave you with a final thought to mull over as you review your own investments tonight. We have laid out the 2 parallel economies operating today. When the seemingly unstoppable force of trillion-dollar tech valuations and endless AI infrastructure spending finally meets the immovable object of surging long-term unemployment and a tapped-out, preservation-mode consumer base, which economy will ultimately dictate the reality of your portfolio?
That is the trillion-dollar question.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.